G'day Gain Squad, I am stoked to have you back on Goldie Gains for our latest market pulse check. Let's see where the smart money is flowing today, because the last 72 hours have been a proper roller coaster. On the menu today, we are unpacking the gold liquidity crunch and the massive shipping shock in the Middle East. We will also dive into the Magnificent 7 tech performance and why the SPIVY TACO trade is trending again. Plus, we'll analyse the RBA interest rate hike and what it means for the Aussie dollar and our local shares. Before we jump in, remember this is just for entertainment and info, not financial advice, so do your own research. The main big question is this gold dip a temporary wobbler, or are we seeing a structural shift in markets? Tell me what you reckon in the comments, hit that like button, and subscribe to join the Gold Getters community. Breaking news first, and it's still a shocker. The Strait of Hormuz is effectively closed to most global traffic. This narrow waterway is the lifeblood of energy, handling 20% of the world's crude oil transit every single day. Shipping through the Arab Gulf has halted following those heavy attacks on Iran that kicked off back in late February. Smart money is watching Singapore very closely, where bunker fuel prices have more than doubled since last month. Very low sulfur fuel oil hit $1,120 per tonne this week, up from $490. This energy spike is acting like a massive tax on global trade, and it is making everyone scramble for cash. Freight rates for India have rocketed to over $3,000 per container, which is absolutely mental for importers. Meanwhile, the Trump administration has launched investigations into European trading partners over military exercises in Greenland. Operation Arctic Endurance has triggered threats of new tariffs on 8 nations, including the UK and Germany. This geopolitical whiplash has sent global stocks lower, while giving the US dollar a big safe haven boost. Let's talk about the black gold, because WTI crude oil has been jumping around like a one-legged kangaroo. WTI futures opened near $98 on Monday and hit a wild spike high of $120. As of March 19th, the price has settled back down to around $94.12 a barrel. The OVX Oil Volatility Index is currently screaming at a reading of 121. This is the highest level of oil volatility we've seen since the early days of the pandemic, back in 2020. The market's having a bit of a wobbler because nobody knows if a ceasefire is coming or if the war escalates. US diesel costs have already topped $5 a gallon, which is putting huge pressure on inflation data. High oil usually helps gold, but right now the US dollar is so strong it is acting as a massive headwind. Traders are watching the oil charts for a breakout, but for now, it's all about that extreme volatility on the OVX. Don't sweat the dip, gold getters. This just means there is more room in the pouch for the next leg up. Now, looking at our own backyard, the Reserve Bank of Australia has pulled a real Swifty on the markets. On Tuesday, March 17th, the RBA raised the official cash rate by 25 basis points to 4.1%. This was a second consecutive hike, and it caught many in the Sydney financial district completely off guard. The vote was a tight 5-4 split, showing the board is really struggling with this sticky inflation. Governor Bullock warned that more hikes remain possible if inflation expectations become unanchored in 2026. The Aussie dollar, or the Aussie dollar pair, wobbled down to 0.705 after the news. However, it recovered quickly and has been trading around 0.7057 to 0.71. Higher interest rates are making the Aussie dollar more attractive compared to other currencies despite the global chaos. The impact on the ASX 200 was swift, with the index falling nearly 3% during the oil spike. But local shares have been buoyed recently by a return to profit growth after 3 long years of declines. The ASX 200 almost hit a record high in mid-March before giving back some gains on Friday. Gains have been led by the big banks and material stocks, while tech has been a bit of a drag. Iron ore demand remains surprisingly resilient, which is providing a solid floor for our local share market. However, valuations are looking a bit rich at 19.7 times forward earnings, so stay cautious. It's a volatile ride for Aussie traders, but our resource-heavy market is holding up better than the tech-heavy US. Let's cross the Pacific and do a deep dive into the Magnificent 7 tech stocks and how they're holding up. Nvidia is the king of AI, but it's been trading lower this week, closing around $179. Options markets for March 20th show an expected move of about 1.9% in either direction. Traders are starting to whisper about an AI bust, with the probability now sitting around 15%. Microsoft is also under pressure, closing at $389.02 on March 19th. The squad is watching Microsoft's massive capital spending to see if it finally boosts the bottom line. Apple has slipped to $249.94 after concerns about slowing sales. Slowing demand in major markets and competition from local brands are keeping Apple in a downward trend. Alphabet, the parent of Google, closed at $306.24 on Thursday. Alphabet is trying to take on Nvidia by expanding its own artificial intelligence chip market with new partners. Amazon is currently trading at $215.50 after a slight recovery. The retail giant is investing a massive $200 billion into data centers and robotics this year. Meta is facing layoff rumors of up to 20% as Zuck pushes for a year of AI efficiency. Meta is also launching new anti-scam tools using advanced AI to protect users from impersonation accounts. Finally, Broadcom reported record revenue of $19.3 billion, up 29%. Broadcom's board also approved a fresh $10 billion share repurchase program through the end of the year. Overall, the Magnificent Seven are down over 7% year-to-date as money rotates into value sectors. This rotation away from US tech is a huge theme, with investors looking for cheaper entries elsewhere. Smart money is shifting toward commodities and healthcare as the AI bubble concerns start to grow. Even on the retail forums, people are saying the easy money in big tech has probably been made. This is a proper golden entry for those looking at non-tech assets, while the big giants consolidate. Now, you've probably heard of the TACO trade, and no, I don't mean the Mexican food gold getters. TACO stands for Trump Always Chickens Out, and it's a term for betting against his tariff threats. The strategy involves buying the dip after a wild policy announcement and selling when the retreat happens. We saw a classic TACO moment this week with the Greenland military tension and the European tariffs. European and US markets jumped on Thursday after Trump said he would not use military force for territory. He mentioned a framework for a future deal, which was enough to send the dip buyers into a frenzy. The TACO trade has worked because the administration often backs off when the market pain gets too high. However, some strategists like Craig Shapiro are warning that this trade might be running out of puff. With the Middle East war intensifying, there might not be a clear off-ramp for the markets this time. If the conflict keeps escalating, the Pavlovian response of buying every dip could lead to some nasty losses. The market's having a bit of a wobbler because geopolitical risk is now the #1 concern for fund managers. In March, 37% of investors cited war as the biggest risk, displacing the AI bubble fears. So while the TACO trade has been a winner in the past, the current stakes are much, much higher. Let's optimize this entry by looking at why gold is falling, despite all this absolute chaos in the news. Usually, war and inflation are great for gold, but the Strait of Hormuz closure changed the game. Global traders need US dollars right now to pay for doubled fuel costs and massive shipping surcharges. To get those dollars, institutions are selling their most successful asset of the year, which is gold. This is a classic liquidity squeeze where cash is king and everything else gets sold to cover costs. On March 18th, gold futures opened at $4,867, down nearly 3%. By March 19th, spot gold was trading around $4,823 per ounce. In India, domestic 24-carat gold rates slipped to 1.57 lakh per 10 grams. In Australia, we saw local gold rates around $238 per gram on Thursday. Central bank buying is still strong, which provides a soft floor, but the short-term pressure is intense. They bought double the usual amount of gold last year to hedge against de-dollarization and instability. This structural demand means that, while the price is dipping, the long-term bull case is still very much alive. Traders are waiting for the US dollar index, or DXY, to cool down before jumping back into gold. The DXY has been flirting with yearly highs around the 100 level, acting as a wrecking ball. But once this liquidity panic subsides, gold is expected to find its wings and fly back toward 5,000. Some analysts even reckon we could see $6,000 by the end of the year if things get worse. So don't sweat the dip, it's just the market catching its breath before the next big move north. Smart money is watching for a cycle low to form between March 18th and March 20th. This could be a generational buying opportunity for those with a bit of brass and a long-term view. Keep your eyes on those support levels, because once they hold, the bounce could be absolutely legendary. Remember that the global financial system is resting on a foundation that many believe is currently eroding. With sovereign debt exploding globally, gold remains the only asset with no counterparty risk at all. Whether it's the TACO trade or the Hormuz shock, the physical reality of gold is hard to ignore. Let's check the charts to see where we might find that proper golden entry for the squad. Gold is currently trading in a corrective phase within a broader structural uptrend, which is normal. If the price holds above the key 4,800 level, the bulls might try to reclaim the ceiling. We are seeing a transition from distribution at high levels into a mean reversion phase right now. This is where the patient traders make their money, while the panicky ones get shaken out of their positions. Let's optimize this entry by looking at our strictly 8-row technical breakdown of the gold indicators. International spot gold is currently trading around $4,846 an ounce. The daily chart is showing a strong sell signal with the bears firmly in the driver's seat. Our RSI 14 is at 39.019, so we aren't officially oversold just yet. The MACD is deep in the red at minus 52.96, confirming the downward trend. We are trading well below the 200-day simple moving average of $5,033. A death cross is looming if that 50-day average crosses below the 200-day line soon. Immediate support is sitting at $4,806 if the slide continues. Resistance has moved down to $5,020, which is our new line in the sand. To summarize the week, gold getters. Gold is under heavy pressure from a massive US dollar liquidity squeeze. The Strait of Hormuz closure has spiked oil and freight costs, making the greenback the only liquid play. The RBA has hiked our rates to 4.1%, keeping the Aussie dollar alive, but the ASX jumpy. Big tech is seeing a massive rotation as traders get nervous about the AI bubble and look for value. The TACO trade is still alive, but it is getting way more dangerous with these geopolitical escalations. Technically, gold is in a strong sell for now, but the long-term structural bull case is still intact. We are watching for a potential cycle low this weekend to mark the bottom of this corrective phase. So, big question again. Do you reckon gold hits 5,000 by April, or are we heading to 4,400? Drop your predictions in the comments, hit the like button if you found this useful, and don't forget to subscribe. We are all in this market together, so stay sharp and watch those key levels like a hawk. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!